Hey everyone, welcome back to Corporate Decoder. Today we're diving into StandardAero's 10K filing their annual report. Get ready for a roller coaster because figuring out this company's financial picture is like trying to assemble an engine with instructions written in another language. StandardAero calls itself the world's largest independent pure play provider of aerospace engine aftermarket services. That's a fancy way of saying they fix and maintain airplane engines, but also offer engine component repair, on-wing service and asset management. They work with commercial airlines, the military, and even private jet owners. A big chunk of their money, about 77%, comes from long-term agreements, but they rely on a small group of big customers. In fact, they're top 4 OEM original equipment manufacturer. Customers account for over 40% of their income. It's a risky situation as losing one of these key clients could seriously hurt their business. StandardAero files an annual report, which is a Form 10K with the SEC. This is their annual checkup. The report confirms a few key points. The document is for the fiscal year ending December 31, 2024, and they're definitely not a shell company. Their commission file number is listed as 001-42298 if you want to do your own digging. They've submitted all their required interactive data files electronically, so they're up to date with the SEC's digital rules. They're also pulling in some information from their upcoming proxy statement, a document they'll file within 120 days about the next annual stockholders meeting. StandardAero is organized into two main segments, engine services and component repair services. Engine services focuses on fixing and maintaining engines, while component repair services handles individual engine parts. Big players like Carlyle and GSE own significant chunks of the company, owning approximately 62.8% and 14.2% of their common stock respectively. That means they exert a lot of influence. It's worth noting that StandardAero's market and industry data relies on management's estimates. While they believe their data to be reasonable, predictions are subject to uncertainty and risk and could cause results to differ materially from estimates. In their own words, they acknowledge having identified material weaknesses in our internal control over financial reporting. They are also subject to ever-evolving federal, state, and foreign laws relating to data, which requires significant investments in resources and could increase compliance costs. They acknowledge that a disruption of their IT systems and capabilities could lead to business disruption and could harm their reputation and result in financial penalty and legal liabilities. And that damage to the reputation of other parties in the aerospace industry, including OEMs and commercial airlines, could harm their business. Now let's look at the numbers. Revenue increased nearly 15%, reaching over $5.2 billion. That's great, but costs also went up. Their top 4 customers accounted for 41% of revenue. That's a little concerning. Their net income is about $11 million. That is up from a loss last year of $35.1 million. But that net income margin is only 0.2%, meaning only a tiny fraction of their sales actually makes it to the bottom line. Interest rate increases could make their debt service obligations increase significantly, since their borrowings under the new senior credit facilities are at variable rates of interest. They must also comply with cybersecurity controls outlined by the Australian Cybersecurity Centre and the 8 cybersecurity controls outlined by the Australian Cybersecurity Centre ACE framework. The aggregate market value of its voting and non-voting common equity held by non-affiliates as of such date cannot be calculated. They're leaning heavily on their upcoming proxy statement. This suggests some crucial details about governance and executive compensation are still under wraps. They acknowledge that they will not be able to operate their business if they fail to comply with the necessary regulatory approvals. This highlights the regulatory minefield they navigate. Inflation has adversely affected them by increasing costs beyond what they can recover through price increases. No director or officer of the company adopted or terminated a Rule 1B51 trading arrangement or non-Rule 10B51 trading arrangement. A quick look at the leadership. Russell Ford is the CEO, Daniel Satterfield is the CFO, and Carlyle and GSE have strong representation on the board. Knowing who's in charge and who influences decisions is always important. They have a ton of exhibits with a complete list of everything they are signed up to. Tobbit, so what's the takeaway here? StandardAero is a giant in its niche, but it's walking a tightrope. They have material weaknesses that could affect their ability to report financial results correctly. They are reliant on only a few customers and operate in a high competition market. They are a controlled company who relies on its senior management team. They also have substantial indebtedness that imposes significant operating and financial restrictions that limits their ability to respond to changes in the economy, and their variable rate indebtedness subjects them to interest rate risk, which could cause debt service obligations to increase significant operating and financial restrictions that limits their ability to respond to changes in the economy, and their variable rate indebtedness subjects them to interest rate risk, which could cause debt service obligations to increase significantly. If they can secure a wide range of engine platforms and diversify their customer base, StandardAero could really soar. Otherwise, they could find themselves stuck in a holding pattern. It's a risk versus reward situation, so an investor should think carefully before investing. That's all for this video. If you like this video, make sure to subscribe and comment for more corporate deco content. Let me know what you think about StandardAero in the comments below, and good luck out there.